Accounting equation or balance sheet equation. So accounting equation is also known as balance sheet equation. That is nothing but assets is equal to liabilities plus capital. Assets means total amount of resources owned by business. Liabilities means total amount of resources supplied by external parties. Capital means total amount of resources supplied by owner or owners. So, in simple letters, the above equation assets is equal to liabilities plus capital is very familiar as A is equal to L plus C and A minus C is equal to L or A minus L is equal to C. Any one of these three is correct, but A is equal to L plus C is the most popular one. Any business cannot start on its own. Either a natural person or a group of natural persons must be behind of that business entity. Those natural persons supply the resources as and when the need arises. Let us learn with an example. Rohit started a business with a capital amount of rupees 5 lakhs in cash, and let's give a name to Rohit's business as Rohit and Co. So Rohit and Co. balance sheet as on date not specified here. So this is the format of balance sheet. Liabilities on left hand side, assets on right hand side. So here the two aspects capital and cash. Okay. See, cash account 5 lakhs and Rohit's capital 5 lakhs. Next transaction. Rohit opened a bank account in State Bank of India with an amount of rupees 4 lakh 80,000. So, this cash 5 lakhs should be reduced by 4 lakhs 80,000. So, State Bank of India account came here 4 lakhs 80,000 and cash 20,000. Total is 5 lakhs. No change here. Next transaction. Rohit bought furniture worth of rupees 60,000 and check was issued on the same day. Check means this is influencing bank balance. Okay, so SBI account will be reduced by 60,000 and a new asset furniture will come here. So furniture account 60,000 and State Bank of India balance now 4 lakhs 20,000. Total amount is 5 lakhs. Total amount of assets. Next transaction. Bought plant and machinery for the business worth of rupees 1,25,000 and paid 10,000 in cash to Messrs. Ramzilal. The value of plant and machinery is 125,000 or 1,25,000, but cash paid only 10,000. That means there is a balance 1,15,000. This will become that 1,15,000 will become a new liability and a new asset will come here and the cash account will be reduced by 10,000. Plant and machinery 1,25,000. Cash account earlier it was 20,000. Out of 20,000, 10,000 paid to Messrs. Ramjilal. So balance amount is only 10,000 and this 125,000 minus 10,000 is equal to 1,15,000. That is new liability. Messrs. Ramjilal account 1,15,000 on liability side. So now external liabilities plus owner's capital is equal to 6 lakhs 15,000. So the total amount of asset side is equal to 6 lakhs 15,000. Let's go to next transaction. Goods purchased from Messrs. Sumit Traders worth of 55,000 credit. See, goods purchased That means new asset will come here that can be said as stock. But no cash is being paid to Sumit Traders. So that means Sumit Traders will become a new liability here. Let's see. Yeah. So stock 55,000 on asset side. At the same time, new liabilities Mr. Sumit Traders account 55,000. Now 55,000 plus 1,15,000, these two 1,70,000 external liabilities. Owner's capital is 5 lakhs. Total 6 lakhs 70,000. On asset side, the total amount is 6 lakhs 70,000. Next transaction. Goods costing rupees 25,000 sold to Rajni Enterprises for rupees 35,000 on credit. See, here we need to understand three things. One, goods costing means cost price 25,000 but sold for 35,000. Some profit is made here 35,000 minus 25,000, that is 10,000 profit. And Rajni Enterprises is a customer, so no cash payment made by Rajni Enterprises, so new asset will come here with this 35,000 and stock should be reduced by 25,000. So let us see the next screen. Rajni Enterprises 35,000, because Rajni Enterprises has taken goods on credit, that means this Rajni Enterprises will pay the money in future. And stock account, earlier it was 55,000, now 55,000 minus 25,000 is equal to 30,000. Here profit is made 35,000 minus 25,000. This profit is owner's money, so it should be added to Rohit's capital. Earlier it was 5 lakhs, now 5 lakhs 10,000. Now these two items 55,000 and 1 lakh 15,000, these two together 1 lakh 70,000, that is external liabilities, and 5 lakhs 10,000 owner's capital, and the total on asset side 6 lakhs 80,000. A is equal to external liabilities plus owner's capital. Assets 6 lakhs 80,000 is equal to external liabilities 1 lakh 70,000 plus owner's capital 5 lakhs 10,000. So at any point of time, balance sheet should always be tallied like this. Assets is equal to external liabilities plus owner's capital.